Well, welcome to Venture with Grace today.
Hey, how are you, Grace?
I am chilling. I just mentioned to you, like I've listened to some of your OG talks from 7 years ago with Eric Thornburg and this like other talk you gave at CMU graduation and you went on some other podcasts, but I wouldn't name everything. But anyway, let's start with you have some like you created like a Netflix thing before Netflix. Was it like the thing? So like yeah.
Yeah, so my first entrepreneurial endeavor was unrecorded and I would say a failure. So when I was in college, I loved movies and I still love movies. And when I went to school, the dot-com was raging and we just had, high-speed internet introduced on the college campuses. So my point of view, and this is going to date me, was why would you go to Blockbuster and get tapes when you can stream movies? And you have to remember, people were pirating content through Napster and whatnot. And so I thought there's going to be these streaming services. And I'd read about this pilot by, well, not Verizon, I guess. It was Bell Atlantic, called Stargazer, where they delivered video over ADSL. And I thought, okay, well, we can build that faster, better, cheaper now. So we actually built, my friend and I, out a protocol to deliver video, and we had a business model, and we were like getting ready to do it. And then literally the bottom fell out. And I remember we'd put in, a couple of grand each, which was a lot for us at the time. And I went to one of our advisors who was at the school, and he was like, well, you're definitely not going to be able to start a company. People don't even want to hire people like you now, but you have a really good senior project. So that was my first foray, and it was cool because I learned a lot. We started doing the research, and I also learned the value of timing because, at that time when I graduated from grad school, about a couple of years later, you had the rise of YouTube, and then Netflix introduced streaming. And you have to really, it's not good enough to have the idea. It's the execution of the idea, and part of execution is understanding how to time innovation. Which, look, to Netflix's credit, they started with just delivering DVDs and built their subscription base, built their relationship with studios, and now they're the largest stream provider in the world. But that's not how they started.
Mm. Okay, so you had okay, I went really OG on like your interviews. I know that is Nigel Morris your
Yeah,
investor and Steve
yeah.
Hayes was your investor from other projects. Um and like yeah, you had like some really great investors. Like what were the kind of like startup scene back then? And then like what were the things that you've took early on, like you've learned early on in your career that you kind of apply to your day-to-day running collective today?
Yeah, so I mean, working with Nigel and Steve. So Nigel had founded Capital One. For folks that aren't familiar with Nigel's history, he's also the founder for venture folks of QED Ventures, which is
Mhm,
one of the leading fintech investment firms. Full disclosure, investor in Collective, and also invested in my first company. And
mhm.
Nigel was on my board. Steve Case was the founder of AOL. Alongside Ted Leonsis. And I had the opportunity to work with all of them as board members and investors in my first company. And it was
That
an
was a
interesting
company that
time.
failed or that
No,
was the
this was
company sold to our Workle, right?
Yeah, and the Netflix story is one that I often tell entrepreneurs is like the company never was. We didn't even incorporate. Like we started
Mhm,
building this tech and the bottom fell out. So to call it a failure might even be a gross overstatement. It was an attempt
yeah.
at failure.
Mhm,
But the actual my first company that I built was called AddThis, and it was basically a tool set. So everyone's really familiar with embedded services these days. So the API driven economy, especially with fintech, right? So it was an embedded service. People could add tools to their website to increase their traffic engagement. We started with social because social networks were popping up fast, and a lot of people were growing quickly. So YouTube, all these other companies were growing because they were adding social features like to enable sharing to these networks. And so our hypothesis was, well, why don't we be Switzerland? Why don't we enable folks to make it easy to share and track sharing? And it was a different time. So I mean, I even had people, the initial publishers that we'd work with, they resisted it. They were like, why would we enable people to share and post our content onto networks? I literally got chased out of offices sometimes because people said they should pay us for using our content on the
mhm,
networks. You
mhm,
guys don't understand, you're young, you don't understand the models. This is not going to work. These social networks are going to have to pay us licensing fees to have our videos and content on the networks. And so
mhm,
it's crazy how much has changed. So we proved to them that's not the case because every time you share, we would show, hey, you're getting more traffic back from the MySpaces of the world and then Facebooks of the world. And then and it's worth it. The investment is worth it. But they didn't see it that way. They just saw it as, hitting their CPMs, right, on their website. If you're Maxim and you make money by selling ads on your site and you drive traffic somewhere else, it's not intuitive for those people.
Mm. I wonder, okay, so you're like very great at like attracting amazing investors, obviously, and then you're very articulate and all that kind of things. How do you kind of like learn about how to sell something? And what do you think is a core essence of like attracting the tier one investors into be on board of your journey?
Yeah, so I mean, I've been very lucky. I've been working with NEA, IVP. You mentioned the QED folks, Revolution. Now more recently working with General Catalyst and BTV. A lot of these are great firms, both specialize in fintech and not. I think that to answer your first question on selling, I think every founder, every person who's a leader in a company has to develop that skill set, and I think it's become a truism, but your job is to basically start to track resources. Ultimately, the first resource is cash, and cash buys you the opportunity to work with people,
Mhm.
right? But ultimately, that's the energy. And so you have to convince investors that, your vision makes sense, that you're backable. You have to convince employees that they should take a risk with their career, their lives, their families in many cases, right? And then you have to convince customers that it's worth taking a bet on a company that for our case, just came out, right? Imagine a financial service provider, the first 10 people that signed up for a collective. That was very risky, right? I mean, even now, several years into the project, we still make mistakes. We're not perfect. But at that time, we were learning everything. And so I think the way to learn sales, in my opinion, and I'm brute force here, is you have to really embrace the fact that you are, in the mode of selling and start to practice and study. You have to put yourself in these uncomfortable situations. I was an engineer, and by background, was not selling, but I think you have to really, really understand the person at the other side of the table. So the number one skill set I think is listening and empathy and trying to truly understand what drives and what motivates the person on their side of the table and seeing if you can align where you're going with where they want to go. And you
Mhm.
just practice reps. And I also spent the second thing I would say from a practitioner perspective, spend a lot of time with people who are excellent at BD. And I
Mhm.
spent a lot of time with one of my early so many of my teammates were instrumental in my life. But at AddThis, there was a guy named Steve Tuhill who I spent a lot of time with and watching how he sold. And um, because if you oversell, people don't believe you. And if you're really, really factual, they're not excited to work with you. So what's that balancing point where you give them enough excitement, you know? So that's what I would say is get the reps in, get uncomfortable, and spend your time with people who are live practitioners, who are best in class, and do it like ruthlessly. Like it's like anything. Put in the reps and do that with respect to selling. And then with respect to investors, there's a lot to do there, but I think you have to understand. I think one of the fundamental mistakes I've seen. So I've invested in 50 companies. I've also founded a couple
Mhm.
companies. When I talk to the founders that I work with, they sell the product to their investors. And that's
Mhm.
not bad. That's part of it. And in an early seed or pre-seed stage, sometimes that's it. That's 80% of
Mhm.
it in some ways for some investors. So you can have this false positive in future rounds that, oh, okay, I just have to keep showing product demos and how slick it is and how good we are technically. Again, very important. I don't want to, but ultimately, what is an investor buying? An investor is buying stock in your company, right? So
Mhm.
what you need to convince them, like in a seed or an A, is that given your vision, given the team you have, given the market opportunity, the next round is going to happen. And so, like when you're doing a seed round, for example, you want to articulate to those investors, hey, we're going to build, the vision is big. Like, so I call it the barbell, but my
Mhm.
execution is great. And they really are trying to assess, hey, will Andreessen do this next? Will General Catalyst do this next?
Mhm.
Like, and they often can call those people and try to validate those assumptions. So I call it the barbell, but you have to sell the company because ultimately, again, they're trying to see if they're going to get a markup on their stock. If
Mhm.
you keep that in mind, the product has to be part of that concert, but it can't be all of it. And that was not intuitive for me when I first came. I had these huge, 30-page decks outlining every feature and technology. And they're like, cool, like, how do we make money?
Um, I like that I think you hit the nail on the head. Like, it's very true that, like, eventually you're marketing or you're, like, basically essentially selling the stock of your company. You need to make at least people believe the next round is gonna happen. Um, so you ran your first company for like 9 years. What were like, I would say, core three lessons that you've learned throughout the 9 years, and what was that 9 years like? So first 3 years, middle 3 years, late 3 years. What did you do in each kind of stage?
So, yeah, I mean, look, it was a long journey, the first journey. I think it was lengthened by the fact that there was a pretty material uh, recession in the middle of it, right? So the period, and you can argue when the dates were, but like I think the tumultuous period was between 2007 and 2011, which was pretty disruptive, I think, for not just us, but the whole space. Um, Lessons learned. There's a lot. I would say, first and foremost, um, the first value in my first company and the first value in my second company is people first. Ultimately, you have to remember the business is pretty simple. It's one group of people, a company, on a mission to help another group of people, the customer. And when you
Mhm.
lose sight of that, things get modeled, right? You start to lose focus, right? Amazon has this value of like customer obsession. So I think the first thing is make sure that you're very diligent about who you work with, and also you are going to make mistakes, right? That's a given. It's a probabilistic process. It's not, there's no, you don't try to hit 100%. But then the second part of that is, hey, what's the standard by which people have to operate when they work in your company? How can you help them get there? And if they can't make it, how do you make those tough calls to find the right people on your team? Right. So it's, I think, don't forget the people part is everything, because when you have downturns, or if you're ripping, your speed of acceleration on growth or your ability to get out of these very tough times is just the people, right? Um, the second thing I would say is patience. You have to be very, very patient. Um, I think you always, as an entrepreneur, over index on what can be accomplished in the first 2 to 3 years, and you underestimate what can be accomplished in 10, right? With AddThis, when I look back, product-led growth, CAC 0, 15 million free customers, tracking 2 billion unique users, processing, trillion page views a year. When I started the business, though, with my co-founder, when the early engineers came in, I don't think we anticipated that level of scale. We'd hoped, and we didn't anticipate it. And I think we underperformed in some ways for, relative to our expectations in the early days about how far we could get on product and how far we would monetize. And so trying to have that lens of like a longer view, I think Bezos and Amazon do an excellent job on that. And just having some patience built into the DNA of the business from the top down, even with your board and investors, right? um, it's hard. It's really hard because there's a extreme pressure um, to do a lot in the short run because of the
Mhm.
way markups work in investments. But you may deprecate the quality not only of the team, which is my first thing, but also the second part, the quality of the product itself. And then let's see, what is the third big one? Um, I think for me, and this may be a very personal lesson, is the initial conditions, the first principle for your success in a company is that you are healthy and alive. And I think when I was younger, and I think some of the founders now still do this, but the culture's improved tremendously. I think that it was the work hard, play hard environment when I was younger, but there is this mythology of the founder of self-sacrifice, and that can often be late nights. That can be I don't work out. That can mean I'm not eating well. It can translate into other tactical problems, but
Mhm.
it's like imagine a company as a child. Well, what good are you to the kid if you're dead? Right? And
Mhm.
honestly, your performance gets so degraded when you're not healthy, when you're stressed out. And so if I could go back again, I really got sick actually during the recession. So I got an ulcer, I gained 40 pounds. I was very I don't cavalier with my health because I was young and I just thought, oh, you power through it, I'll be fine. I never had that feedback loop where I got hurt. And then when I got hurt,
Mhm.
like I was like, oh my God. So those are just there's a lot, but I think those are the big three. Um, and I think the phases of our development, when I look at the years, I think the first phase was product market fit, very classic. And again, the resources at the time were different. The rounds were so small relative to what they were, and the scrappiness that you have to have were very different than this current history. Even with the correction occurring, I'm still seeing seeds at like 3 times higher than my A, when I did it. So it was really about product market fit. And what happened for us is we found the right products that were ripping, for freemium model, and then we had a product-led growth loop. And so I think we overperformed in that. I think the second phase for us was really about monetization, and that occurred during the dark times, if you will. So we were testing things during the worst period of monetization, and that was those couple years. And so we were really focused on learning how to have a model that was consistent with the free tier, but monetize well. So we started doing data as a service, for example, which was one of the large models in subscription. And then the third phase was really scaling, which led to the exit. And that was, I would say, during the recession and after the fact. There was a lot of trials and tribulations, which I'm happy to discuss. But I'd say the recession was really hard, not just on the team, but the moment for me was where I went from founder to CEO, was that recession, when you have to look in the eyes of people you care about, and you have to say, hey, I don't know what's going to happen in the future. So the only thing I can determine is we have to lower our cost to buy time. And there's people that you have to say goodbye to. It was very, very difficult for my team. And for me, what I did was I wrote down everyone's names, and I think I've told the story before. I don't know from Tuska, and I kept it in my desk, and I read it every day until we sold. Even when I wasn't there full time, I was thinking about these people, and I wanted them to feel proud that the thing that they built had an outcome, you know, because that was meaningful for me, and that was my biggest reward actually at the exit, was that I had this relief that those people, along with the people that were there, could discuss it as a win.
Mm. I wonder, when you were thinking about, I guess, like, so I wanted to ask, like, maybe this is like a really small detail, but like, okay, between SAMU to AddThis, there's like 2 years. What did you do in the 2 years? And it seems like, you're like the only founder that I've met that like never work at like a big tech, or have like some 45 years work experience before they start something, or you seems like you've been always like an entrepreneur. I don't know what you did in the 2 years. Like, how do you kind of like know what to do to a degree? Because I think a lot of people, even yesterday I was chatting with someone who are trying to figure out their career move, like my peers, and or like my younger peers. Like, people are trying to figure out their career moves. They are kind of clueless on how to start a company, even they're like amazing at what they've done in the past. So I wonder, how do you kind of, if you have never really worked somewhere, how do you get over the self doubt on like, if my resume is missing something?
So I would say, look, for that period, the time before time, my co-founder and I, it was a different time, right? So you have to remember, it was post.com. There wasn't a lot of venture dollars. Um, it was a very harsh bar to start. It was the beginning of what was called Web 2.0. And so there was
Mhm.
this, I would say, Precambrian explosion where you started seeing companies come out like YouTube and MySpace and Facebook.
Mhm.
And there was all these initiatives that like started popping up. You had the rise of web services, like REST came out. It started to get innovative. So, but look, reality is, you say, oh, well, how do you know what to do? I didn't. And that was part of the problem. So, we kind of stumble our way through in the darkness. Now, I mean, you look at I can literally ask AI how to start a company now. Like, think about the difference. Then I couldn't even Google search. Google was only out for what, it started in 98, 99. So at that time, it was like 5 years. There was no articles, there's no blogging platforms, there's nothing. And so, honest to God, I would talk to anyone who would sit with me. So there was,
Mhm.
I got a lot of mentors. So the founder of what became FedEx Ground was RPS. He was one of my mentors. I had professors, at Carnegie Mellon, who are my teachers, that were very, very instrumental and helpful to us. Um, and I spent time with people who had done it, and just asked. But that's a slow process, and I fumbled my way through it. So, hey, we incorporated. Okay, that's a win. Oh, we have to do taxes. Like, it was literally like that basic. So it took us a long time to get to a point where we're just testing different concepts. And once we kind of went through that gestation period of like consulting and being on our own, frankly, as human beings,
Mhm.
alone in this little entity, we got exposure to VCs through, one of our advisors, this guy Dave White, introduced us a bunch of VCs in the West Coast. So it was literally just back to your point on sales, I was just hammering anyone who would sit with me. I was in Pittsburgh when I started, and out of school, so I was just anyone who would sit with me. I'd get on a plane, I would drive a car. I remember I drove to DC back and forth when we were pitching to some of the AOL people and our early investors, and I couldn't afford to stay there. So I would drive to DC from Pittsburgh, do all my meetings, and drive back at night. So it was a 8.5 hour round trip, 9 hour round trip, and I would do it like every week when we were closing up our first round. Because I mean, it was just different time. So I would say for folks that are founding now, it's put in the reps, go in and have the patience. And it's not this like, now you have more playbooks and you have more tools, you have things like YC. I think Gary is doing a great job with things like YC and the more structured programs, but the bar is higher and the speed is
Mhm.
faster. So it's a different game than it was then. So we would go a little slower, but we had no, like, Google Analytics came out while I was building my first company. And so yeah, I think it was just a very, you have to have a willingness to fail, and I think that came from my engineering background. But actually, other founders, there are other people that I know. So Garrett Camp, who's a friend of mine who'd started Uber, he started StumbleUpon in grad school, and then I think Josh Koppelman and others, they funded him and moved him down, or it was like shortly thereafter, for Canada, and then he came down, and he's never worked for anybody
Mhm.
ever. So I think there's a lot of founders in our kind of cohort that were out of school, because that was also still a thing that was like very popular. But I think, look at Pear Ventures, Pear Pagemon and his partner Mar, they have amazing, they focus on people who are out of school. Dropbox founders were out of school, for example, like Drew, I think started out of MIT. So I think it's still a thing, but so much of it is just understand, it's not even just believing yourself, it's just like resilience. You know what I mean? I think founders have an unparalleled resilience. The good founders, like, they can tolerate so much pain, right? And they stay focused and they stay patient, because half of the reason I see my companies fail is people give up. It's not even just the concept, it's just they can't take it anymore. And that manifests itself in different ways.
Mm. I wanna say hi to the audience. Hi, Sandeep. Anyway, so I wonder, um, so you had a really successful exit. What does it look like to have an exit? Because I feel like a lot of the listeners or, both, like, founders and investors, like, they've in my era, like, so in my generation, they probably haven't seen an ad exit yet, or, like, they've seen maybe, like, heard about this one person's company that blew up, right? So I feel like in your era, you probably seen a lot happen, and you yourself, like, have sold a company for, according to TechCrunch, it's like $200 million. So I mean, I wonder, how do you sell a company to a big company for like $200 million? So like maybe for you, it's like not the end, but like for a lot of the listeners, it's like a dream, right? So how do you kind of like achieve that outcome? How do you engineer, like reverse engineer, like the outcome to what you have to do today?
So I think if you build a company to exit, and
Mhm.
I've seen people do that and it can work. I don't want to discount that that's a strategy. I would personally think that I wouldn't recommend it as your dominant approach. I think the trite feedback that I often have for folks is, you have to build something that's intrinsically valuable, right? And that people desire, and that integrates with an ecosystem. Like, ultimately, so Oracle acquired us. At the time, I believe we had three different partnerships with them. And it was after the third where, someone over there said, wait a minute, let's do the math here. Does it make sense for us to have this capability? And I think at the time, they had an initiative called Data Cloud that they were building. They bought a company called Blue Kai. And so we built something at the time that was perceived as valuable, but this company, we had aligned with this company and they understood the value. They didn't have, it wasn't like this cold selling. I think that really great outcomes, the best outcomes, and I think we were good, but you've seen like phenomenal outcomes. It's often companies are bought, they're
Mhm.
not sold. If you're in a
Mhm.
point where you are creating an auction process and you're trying to engineering it to be sold, um, you can be in this like local maxima. Doesn't mean
Mhm.
it's a bad outcome, but that's often not the best um, position to be in. So I would say just focus really, really hard on building something incredibly value to your customer segment. And then as you're doing that, a background process is, how can you partner? How can you talk to people who are in your ecosystem? So what ends up happening is the people who either can partner with you or would partner with you. So we would go talk to Yahoo and Google and Adobe and keep them posted, try to find ways to work together. And that does two things. One, it can create enterprise value for your investors, but also they get to know you, even if they don't do anything. You know, we almost got bought by so many different people along the way, got pretty close. That's how you can quote unquote engineer it. But it's
Mhm.
in an authentic way, I think, to set yourself up for an acquisition, which is, well, let me demonstrate why this is so valuable through that partnership. Let me actually like build some shared value. And then you're like, wait, I want to have this. I want to own this. I don't want to partner with you anymore. So that's my advice. Don't focus relentlessly on the value, and then try to, the more you can integrate and be part of their ecosystem they view as essential to their strategy in an organic way, you have a higher probability of exit.
Um, I'm taking notes. Organic way. So hi Josh. Anyway, so like say hi to the audience. So okay, so let's talk about your investing journey and your new company. So
Sure.
after you sold a company, you have like invested in a lot of companies. Well, you have invested in a lot of companies throughout, and then how do you like? And then you are like a venture partner and founding partner at Expa. Tell us more about that. I know that's started by the Uber founder you just mentioned, and like how how does like investing in other companies that kind of like shape your thinking on starting your company? Also, you have a really good portfolio. Like there's Uber, there's SpaceX, there is Sweet Green, there's like a bunch of companies we know. So let's talk about like that.
Yeah, look, it's been tremendous. I part of it I think is timing, and one of the things you learn when you invest, which is fascinating, is like, were you good or were you lucky? Like, was that vintage good or was
Mhm,
it you? And was it circumstance of your network at the time? And I think you see some of the, I really admire the players who have gone through multiple iterations and consistently perform, because I think the outlier, if you were to like do a regression in the R squared, is them,
mhm,
not the circumstances that they're in.
mhm,
Um, but yeah, when I think about, I'll talk to you a little bit about Expa, and then I can talk about how it shaped my perspective, because it was very formative for me. Um, so Expa is had a unique origin at the time. So Garrett, our founding partner, had done Stumble Upon, and that's how I met him. So during that social, we were
mhm,
integrated with them and 300 other social networks, and I think that's one of the currencies that founders uh, maybe don't think about enough, which is, yes, you make money, yes, you have an experience, but the reputation and connections you build can often generate more value and more monetization than you would ever make on your company. I know people that have made more money on the third deal they got access to than any of their companies, all of them combined. Like, I'm talking 100 times more money. And
mhm,
so if you play this longer view that you're part of this ecosystem, and it's about like capitalizing on the shared innovation, you
mhm,
can have a much richer outcome if you look at it that way. So Expa for me, so Garrett had built Uber Cab, and I think he kind of was looking at, from my perspective, hey, how do you build a company that builds companies? How can we be a hands-on partner to these entrepreneurs? You have to remember, when our generation of like entrepreneurs, which again wasn't that long ago, but many of the VCs were bankers by background,
mhm,
management consultants by background, had gone to really great schools. And I don't think any of those mean they're not good investors. But what it does sometimes mean is that in the 0 to 1 stage, where we focused in seed, pre-seed, when you're looking for product market fit, they don't have operating experience, but specifically, they've never actually built and shipped a product. And so we thought, well, what if we got a group of people together who focused on that? What if we were the hands-on partners we didn't have? Garrett had built Uber. Our other partner, Devine, had built Foursquare. You know, we had another partner who had, been the initial designer for Twitter and co-founder of Envoy. So all of us together said, okay, well, what if we brought that together and we only focused relentlessly on that stage, and we either work with first-time founders and we would co-create companies with them, or if they have come with an idea, like we had a company Sleeper, which is just doing phenomenally. Um, how do we just be good partners to them and hands-on, and really understand them, with empathy? Again, I use that word. It's important because that stage is vulnerable. It's very emotionally taxing,
mhm,
like. And so that was the thesis. And we were, I think the first one was 50 million, and we had some really great projects that came out of that. So Current, which is the second largest neobank, I think, right now in the US, to Chime, Metabase, which is the largest business intelligence platform. And so from an open source perspective. And then we did fund 2 and then fund 3. I think, now the team's on fund 4. And so for me, a lot of things came from it. One, obviously Collective kind of came because my insight was I love serving founders. It was amazing. You know them, you understand them. And so I love that, but I missed the scale of the opportunity to AddThis, right? I missed also having a team, building a product to achieve that scale. And I thought, is there a way where I can be a founder again? Because I missed that, helping these founders at scale. And when you look at Collective, the largest group of founders and the largest part of the working force are these 38% of solopreneurs. And so that was kind of how I went down that road. And to kind of close the loop, you asked me a question. You said, okay, how did it influence my experience? Okay, so obviously I started a company as a result, which has been tremendous. The other thing you learn though is founders working together can be great teachers for one another. I learned so much from the people I worked with and invested in, not just from Expa, but for my own portfolio, like Justin, the founder of Hinge. Oh my gosh, I learned so much watching him build. And you learn things that they do better than you that you can kind of learn and emulate. And you also learn wow, I wasn't as bad as I thought. And so you can get a more balanced perspective of how to found and how to be on the other side of the table. Like, again, I told you, investors, they ultimately want the markup. They're looking for the return on investment. Yes, they want to be part of something great and all those good things, but you start to learn how it feels from their perspective when a founder comes in a board meeting and misses. How does it feel when a founder's all over the place? Like the things that you would be like, why don't they understand? I'm like, oh, okay. This sucks because I have to go back to my partners and say why this founder went off the rails and isn't answering our phone calls or whatever bad thing can happen, right? So it helped me, and I believe, be a better partner to my new investors now, be a better partner to my team to understand how we can build and communicate with those investors, and also ultimately got me to Collective. I don't know that I would have come to this conclusion without that experience.
I have a couple questions for you. I feel like, as I've chatted with a lot of like emerging people or emerging manager, emerging LP, blah, blah. So I think they have not seen company that much like that are went pretty big. I think like people have seen the founders that are like having some small scale of success, like which is like raised the next round from like a tier 1 VC firm or something like that. But I think a lot of people have never really, like you said, like worked with the founder of Hinge, worked with the founder of Uber, worked with people like yourself, right? So what were the lessons learned that like, what does a great founders look like in general? And how do you kind of like recreate that experience if you have never really like worked with them?
So I have a lot of points of view on this. I'll try to give you a couple of succinct anecdotes here. I often, whenever I look at like a new company now, so there's operators who invest sometimes have a bias towards, oh, if this founder does A and B that I would do, or I can help them with that, they will be successful. And I think one of the harsh lessons you learn is they may not do that. So what I look for now is, I call it kind of the train. So that founder, they may stop for 2 minutes and let you get on the train, and maybe you can help them, operate the train better, maybe help them go faster, but they're going to go, and they're going no matter what. Whether you get on it or not, they are going to be successful because they're self-driven, they're self-motivated, they're resilient people. They may not know how to solve the problem, but that they have this like fanatical belief that they can move forward, right? And that doesn't mean they don't have insecurity. It doesn't mean they have down days. I'm not saying it's because that can get mythologized as well, but that's the psychology, I think, of the most successful founders I have. They're incredibly resilient, and they're amazing at quickly learning. They're great at this like continuous self-improvement at a radical slope. And so when you combine someone who won't give up and they're self-learning, you look at them and it's like interest that compounds over a couple of years. You see these crazy founders. Like, I mean, I can give you so many examples, but we talked about Hinge. Justin, I look at Hinge now, it's like, I don't know, one of the top 3 dating apps. They're doing hundreds of millions in revenue. I mean, when I first met this guy, humble as he was, he's very bright, but like they were like a Facebook app, and when Facebook apps were a thing, and a lot of your listeners probably don't even know that that was a thing, that Facebook enabled you to build apps on there. And the concept was date friends of friends, and it was like he went from that to this. He's evolved the vision so much, but it's his resiliency, and he really, that's the thing I think I admired the most, is he just kept pushing forward. And actually, I think if you look at how big it is, the majority of this, how big it got, was after he even sold it. It got bigger after he sold it.
Mhm.
And so that's just one example, but like so many companies are very different. Sleeper's another example. They had amazing, extreme product market fit for their first offering at the beginning. Um, but they kind of broke things into phases with growth and monetization. Now, I mean, without disclosing too much, they're incredibly, growing so fast from monetization perspective. I haven't seen anything like it, but it took them years. The founding team like would work in this, like their friend's house when we met them, right? And they were just so stingy, but they just kept working. And so I know it sounds trite, but that's kind of what I think is really, really critical in a founder. Um, I have some like crazy theories about the psychology of founders I'm happy to share with you, but they're maybe more controversial. But that's the profile.
Mm. What are the controversial things?
So my controversial theory, which I guess is recorded, is what it is I think when you look at, there's two things I'll give you. One, a lot of the founders that I've seen that are successful, and it's not everyone, but a lot, have experienced what I call tolerable trauma, and they've overcome it. So what's tolerable trauma? Their parents got divorced. Immigrants, 40% of Fortune 500s are started or run by immigrants. They were adopted. Steve Jobs adopted, right? Larry Ellison, I believe, was adopted, right? Jeff Bezos adopted. Okay, why does that matter? Here's my theory. People that have that trauma are forced to develop a resiliency at a young age. They overcome whatever that trauma is. And if they can get through it, while it's painful, I don't encourage parents to go torture their kids, but like my parents were immigrants, so we had that. And then my parents got divorced. And so I look at it and I was like, I was so independent because I had to be, and I was so resilient. I almost like had to be fanatically by myself, that I was like, fine, I'm already by myself. It can't get worse than that, And I'm not saying my parents were
Mhm.
great, but do you know what I mean? It's very different than
Yeah.
if you're in this environment where now you hear about the coddling of American children, for example, and there's this like trope around helicopter parents, and they're like overly scheduling them. Well, those people aren't as resilient, because when you put them out in the world, we need structured environments. Whereas these people of tolerable trauma are thrive in unstructured environments. And so that's one theory. And the second theory, which is maybe the most controversial, is, there's this term called sociopath,
Mhm.
and I think, like, look at Asperger's and they call it spectrum. I think there's a spectrum of sociopathy, and with like the extreme part being like you're lawless, reckless, you would hurt people. You don't have any regard for the rules. You don't care.
Mhm.
You have no feeling. But I kind of think that entrepreneurs are on this, like, on the spectrum, and they're mild sociopaths, and they just don't believe the rules apply to them. Fundamentally, they don't think so. Like, why can't I go start a company when I'm 25? Why can't I be a billionaire? They just like really don't understand that this applies to them. So when their psychology, people say, well, what does it take? It's like those people, they don't care. Like, look at Zuckerberg, man. The kid was 19 and I mean, it's crazy. I don't think he thought any of the rules applied to him. And they broke a lot of rules. They do email imports, and it was kind of shady, and they'd spam your friends. Max Levchin famously said, if you're not violating the terms of service, you're not doing anything interesting. Airbnb broke the law in many cities when they're going to. Uber broke the law, right? We make them heroes, but like it's kind of like, sociopath a little bit. And so that's my controversial kind of thing. So those are the two things I've kind of seen as a pattern over the last 10, 15 years.
I wanna double click on that a little bit. Like, how do you know? I feel like you can only see the result later, like, otherwise they're just be considered as, like, mild sociopaths, right? Like, so now they're, like, successful founders when they're successful. Like, how many people that you feel like having that mindset, but actually went to jail, like, versus, like, they're, like, very, very successful?
Look,
I don't think went to jail is, like, the right
I
phrase, but,
think
like, it's more like yeah.
so. I mean, look, like I can give you more benign examples. Like look at the way that all of the formation of OpenAI. It started as a nonprofit. and then all those people invested in one thing, and then they're like, hey, just kidding, we're going to be a for-profit. And oh, by the way, we're going to train on all this data. Like, what are the copyrights? Like, of course they thought they were probably doing the right thing, but like it was probably great. I doubt the lawyer was like, yeah, don't worry, everything's chill. They probably gave him a gray zone and they're like, yeah, well, who cares? Like, I don't even know if this is going to work. Right. So again, for that particular um, type of person, I think it has to be tolerable for society. So it's like if you get a person who went through tolerable trauma, who can be a tolerable social path, you can get these crazy results because they have this insane resiliency. They're used to being themselves,
Mhm.
and they also don't understand why they can't do something. They don't get it. Like think about how crazy it is if for Sam Altman right now. Like the guy will raise a crazy amount of money for a new project. And we just are like, oh, that's okay. That makes sense. Elon Musk, the guy send a rocket. He's sending rockets to space. He's doing electric vehicles. He's building ground holes in the ground. He's building links to your brain. Everyone's just like, oh, okay. Like there has to be a certain disregard for what's possible, like the rules, quote unquote. And the rules doesn't just mean you're breaking laws. I'm talking about the imposition. The society will tell you that you can't do things. Oh, well, you need work experience. Oh, you don't know how to start a company. And people believe it because that's the rules. That's the norms that are imposed on them. These people don't understand that. Like when I was younger, I'm like, why can't I do this? I don't know why. I just didn't think it applied to me. And it wasn't, I don't know if it's hubris or arrogance or what. I just didn't register that this was a problem. I'm like, well, I'm already broke. Like I don't have money out of grad school. What's the actual outcome? Oh, so then I work at Microsoft 2 years later. Okay. So you know what I mean? But like, I think there's those two pieces of psychology. You have to really look at what the founders, of course, they have to have intellect. Of course, they have creativity. All those things are true. But you want to look at like people that go up here. There's this like in those two things I've noticed a lot. Anyway,
Uh,
theories.
like for the childhood trauma, um, can they be like later trauma, like when they're adult, or like you feel like that's just like the childhood is like where you built resiliency?
I don't know, obviously, and we're building assumption on assumption. I would imagine that it has to be at ages that it has impact. And I think the older you are, let's do an example. If I'm, older, if I go through a trauma now, I'm going to have a whole set of tools to deal with it that I didn't have as a younger person. And so I don't know if it impacts your personality as much. I think you need whether the timing of it, I'm less sure of. I hypothesize it's when you're younger, and younger being, let's call it, I don't know, born to, I don't know, teenager, for example, because those are really formative emotional years, right? And in particular, when you're a teenager, your hormones are like out of control. So like the memory kind of shifts are crazy. Like if you think about people's favorite songs and they go back and say what music is good, they almost always cite the music from when they were like, I'm making up 12 to like 20. Why? Because it's like imprinted at these times that are formative for them, right? And so I think having the trauma in those formative times has an outsized impact is my prediction. Again, it's not necessary, nor is it sufficient, but the outcome that it drives, you should look for, which is the person has to have some sort of like top percent of resiliency because it's just so, I mean, you're like literally always failing when you're building a company, even the good ones. It's just like always broken. People see this outside view, but it's always broken, right? And it feels terrible. And so if you don't have that resiliency, you have to earn it somehow. Um, so that's one way.
Hmm, that's we went so off track, but I love it. Like, okay, so let's talk about um so your investment. Like you invest in Uber, SpaceX, and all these other companies. Like how at what stage do you invest in these companies? Like were it more like a angel investing that kind of like pan out, or what was it like more later stage, secondary, or like I don't know, like how do you see it in the investing landscape? Like were you I feel like after building collective at one point you will be like a full-time investor. What were things that you have like learned that will make a great investor?
Yeah, so I look, the majority of my investor investments have been at the earliest stage or an advisory. Like whenever I work with companies on those levels, I tend to work at the early stage and start early. So call it like A and earlier. And that's just my exposure, frankly, and my interest. So a lot because of Expa, a lot because I just, where I was in my trajectory. As I've gotten older, as I've gotten more capital, as I've gotten a bigger network, you start trying to participate along the way. As companies offer secondaries, as companies, are larger, I can apply capital in a way that I couldn't, it's not like a 50 grand check or 100 grand check. It's, so those I've changed. I'm doing more in a different way, and I think the SPV structures for folks that are familiar with that have really enabled you to harness your network to create opportunity. And so that's like on the terms of this my focus.
Mhm.
In terms of things I've learned, I think going back and forth between operating and investing,
Mhm.
the common thread though is operators and investors want the same outcome. And I keep going back to this, but I don't want to oversimplify it, but your goal is to make the share price as valuable as possible with the least amount of capital. And to understand at the different stages, you get more and more, insight as to how to value the stages. Like I've over indexed and I've super indexed on pre-seed and seed. So when you look at it, you're always kind of looking at the same criteria, but you index higher on certain things. So for example, pre-seed and seed, yeah, you want to look at the team, the market, the business opportunity, the disruption in terms of problem solution. It's the same stuff that a Series C investor is going to tell you they want to look in. However, at the early stage, because there's nothing really built, you over-index on team because they're probably going to pivot. They're probably going to have to learn on it. So you have to bet, is this the team to get through it? Whereas in
Mhm.
the series, where we are as collective, we've raised 80 million bucks. That next investor, yeah, he'll look at the team. They're gonna look at all those things, but they have historical data. They can do cohort analysis on churn, retention, CAC. And so they'll probably over index on the actual performance as a predictor of future success. And so just going through on both sides and either as an observer and a buyer of that stock and
Mhm.
as a creator of value, you're still fundamentally understanding how people are assessing values, how to package that and how to, look at that. And so I feel like I hope I can be a better partner to all of my founders because now I've, kind of done it across stages on both sides, sharpening that tool set though ultimately of like, hey, you need to create this like real value. And at the beginning it's different, right? Like the beginning pre-seed and seed are like prison rules compared to, A through D. It changes. It boils down to numbers at the end.
When you are thinking about, um, so now you're on the other side of the table, you're betting on these founders who will make the quote unquote stock goes higher.
Hmm.
You said they're like tenacious founders who have some trauma and mouth sociopaths. Like, what are some other benchmark for them to get the next round of funding? Realistically, like, because I don't think we'll meet like Elon Musk every day, right? Like, so there's like a lot of companies that still are gonna raise like a really good next run, but they may not appeal as like a little bit like too crazy or whatever.
Yeah, look, I think so much of your pitch depends on the stage and what assets do you bring to the table. So I always encourage people to understand themselves before they understand what the company they're selling. So for example, when I was younger and I'm a first time founder, what you don't want to do is go into your seed round with, and I'll kind of hyperbole here, like a really like great, like I had business training. I could do complex financials and I'm, math oriented, but that's not a good way to sell when you have no work experience. It's almost like this person that's never done this before is showing me a model. I actually am like really not excited. But hey, I came out of Carnegie Mellon. I was like a hardcore engineer. We were hardcore engineers. I'll remember like I went to one pitch meeting with an advisor and I wore a blazer. It was one time. I only did it once. And he's like, "Why the fuck are you wearing a blazer?" You know, they're buying the flip flop guy at a Carnegie Mellon, and you're selling them a suit, and you've never no work experience. And it really struck me because I was like, you have to understand what you have. And so, look, if you're doing AI, right, those people want to buy. It's people who can like nerd out hardcore on whatever the domain is that you're focused on, right? And so you should over use your strengths when you're selling. And in the earlier rounds in particular, because so much of it is narrative, it's
Mhm.
critical that you understand your role in the narrative because the team is important. I think later on, as you're building the company, especially if you have a longer vision, if you want to really get investors to come in, you have to be able to like really roadmap for them why the stage they're getting on the train is the right stage, right? And how you're going to build a ton of value in the future that's aligning with their IRR hurdles. Like know their fund. How much are they, how big is the fund? What's the IRR hurdle? Has this partner had any wins? Because if you get a first time partner who has no wins, they're not going to operate the same way in a downturn as someone who's done it a couple times. Like Frank Rotman on QED, when we had the downturn, was an amazing advisor, but like the level of stability and kind of sophistication of the conversation that we had was amazing, and it impacts me as a CEO, which means it impacts my team. And so I think like you have to be very careful about basically align yourself with the firm, and then the story that you tell has to kind of connect the dots, right? You don't want to go to Sequoia and have like a really like slow growth story, for example. Like that doesn't make sense. They want to build enduring companies that are generational. So they're not interested in like the next boring widget, right? Even though it's a good business, it doesn't mean it's not a good business and you can't make money. They want the next Google, the next YouTube. That's what their bread and butter is. So you have to know your audience. There are VCs, by the way, who are incremental, relatively speaking. They make tons of money. They're like, we just do enterprise. Like we went into this one vertical space, go after it. I'm not condescending that. They make a ton of money, but like you don't even know half of those companies, and they go public and they're like these like really gutsy enterprise companies, right?
Mhm.
You hear about the snowflakes, but all of these other ones you don't know as a consumer, you know?
Um, so let's talk about collective and maybe like a little bit of like the product building and the fundraising. So why don't we start with how you started with like this product, and then you have some really tier one investors, but I feel like because of your earlier success that kind of contribute a lot to it. As like, people love like a really good second time founder. Um, Tell us more about like, why you're starting this, and as a second time founder, what were things that you feel like are different from the first time being a founder?
Yeah, so just to dovetail on what we'd spoken about before, I fundamentally was excited about Collective because it was for me, a
Yeah.
confluence of an ICP that I loved,
Mhm.
the scale that I had missed from my previous company, and it enabled me to be a founder again, which I really missed. So that was like the emotional kind of pathos that like was
Mhm.
for me. My co-founder and I both, as we explored it, both my co-founders, we thought about, okay, well, why is it? What are like that? All of these, ultra small businesses, we ultimately came up with the term business of one, are not served. And how can we create a platform? Like you have these DIY tools, then you have
Mhm.
service companies that are accountants, and then you have like these enterprise platforms. But there's this whole group of people. And as I did research, what kind of locked it in for me was talking to my parents and looking at their situation. And I never thought of them as solopreneurs. And I've told the story a number of times. My mom was a sole prop. My dad was an S corp. I watched how they ran their businesses from like the cheap seats. And my dad had an opportunity to save way more money on taxes than my mom did over the years. And I thought, wow, that one decision they made changed the game, right?
Wait, what is
And
your dad's? I'm a solopreneur, so I need to know right now. But anyway,
yeah, so like he was doing an S election, which look, that's what we specialize at Collective,
an
and
S corp.
you know yeah, S corps, and so the S elections. And so punchline is like we save our members now a collective $10,000 a year on average on taxes because of this election, and then you have to do administer your business differently. It is more work relative to then doing a sole prop, but the return on investment's very high. And anyway, when I saw this, I'm like, wait, I can really vibe. This is like so many of my friends, I just didn't think of them as businesses. They're professionals. You think of them as a realtor or a lawyer.
Mhm.
And so when my brain expanded beyond like, okay, Uber drivers and like the stuff that's in the Valley zeitgeist, I
Mhm.
got very excited. And so that's what got us in there. And then what drove Collective as it is today was, to my co-founder's credit, we did a lot of customer research and we talked to hundreds of people and realized their pain point is tax. Like ultimately, like, why do you do your books? Why do you do payroll the right way? Why don't you just, because you're afraid of the tax implications? And they either were doing it wrong or they thought they were doing it wrong.
Mhm.
And so we said, well, how can we have a guaranteed way, like a hook that helps them? And we subsegment the population. A lot of people who go after solopreneurs like to go after the big base, like everyone getting started, gig workers, like that's popular. We did the opposite. We did what Uber did. Uber went after black and then they went down market. We went for customers that higher incomes because, as I mentioned, all things being equal, these people could in theory, save a ton of money with a S selection and an administration of their business as an S corp. So bookkeeping, payroll, tax, like we could set up a system to realize that savings, and that would be our wedge. So we like started running ads basically saying, hey, do you want to save all this money? And it turns out they do. And so that was the beginning of Collective. And we built, it was the first online platform just designed for these high-end solopreneurs so that they had a financial partner. And our kind of hope was, you only like Rippling is great. It's a great company, but it's enterprise, why can't these people get software driven solutions? Why can't they have an all-in-one solution like Rippling? And so far it's proving to work really well. And we have a lot of work to do. We have a lot to build, but in terms of the model itself, in terms of the business need, the product market fit's incredibly strong right now.
Mm. How do you go to market with this idea? And like, do you build the product first? Do you like launch a fake website to collect people's email? And what are some things that you've took from your first company to your second company?
Yeah, so we had a very, I would say, progressive go-to-market because if you look at where we are now, I mean, it's a heavy, heavy platform. We have a bookkeeping part of our platform. We have a tax part. We have a payroll part. I mean, this is a big platform, and we still have product work to do, even though we've been spending years. Because it's just like the analogy I use is like almost like NetSuite or ERP. These are huge suites, and so we could have just built this whole thing and then seen what happened, in
Mhm,
theory. But that would have had an outrageous amount of capital and risk because we don't have this product
mhm,
market fit. Because ultimately what we broke it down into, and this is kind of venture inspired, but like how do you break into these provable smaller sub goals? So the first thing we wanted to see was, okay, are we right on the value proposition, right? And so the very very first thing we did was set up the website and try different Facebook ads and see how much it costs us to acquire an email, and then at a reasonable conversion rate, would the CAC make sense if we assumed some pricing model? We just did back of the envelope. Then we're like, okay, they're signing up. Then we called them and we said, okay, what did you think you signed up for? And then we validated that, hey, if we build this all-in-one platform, that it could work. Now we're like, okay, well, we're not going to raise $40 million, $50 million, to go build this. What can
mhm,
we do now to learn? And so we actually partnered with a third party, one of our advisors, gave him a Collective email. He ran a small kind of practice in Texas where he did a version of Collective, and but it was all bespoke. He'd set up your QuickBooks, your Gusto, all these things. It was all managed, no logins, nothing. And we
mhm.
said, okay, let's partner with him, and we'll give him the business, but we'll learn how he's doing it and see, do people stay if we forward those people, and does that math we said make sense? And then the answer was yes. And then we again, okay, well, let's build it. Now we have proof, and we just kept doing it like that. We just kept building up the proof points, and now here we are. So it was very iterative, because there was an extreme amount of capital and risk that we would take if we would have just built it at the beginning.
So you found someone um in somewhere to test this out. Can you like unpack that a little bit? Like, how do you find this person? What does it mean for like testing out like a part of the project? Like, basically what's your core product offering now versus like the prototype kind of thing? And then what kind of CAC are you looking for to, you know, think this is like a viable business? I think this is really amazing thought process. And like, I just wanted to kind of like
Sure.
dig deeper. Yeah.
So the way we tested, so basically he offered formation. We had formation, bookkeeping, tax. Those were the
Mhm,
core pillars. And by the way, today we offer formation, bookkeeping, tax, and payroll. And so he did his managed service. So in lay terms, if you had a super accountant, most accountants will only do part of this, but he kind of figured, oh, if I set this up for S corps,
mhm,
literally, and I can do this. And he would offer a subscription, flat pricing. He would manage the whole service. Now it was very like you have to follow his rules, and it was very like limited in scope. But it was similar enough to what we thought we would build that we thought if we give him the leads and he runs it with our email, right? Like, and the customer has the experience and they stay. Okay, well, we think we could run that, right, at a certain margin profile. But if we build software, we can make it more like software as a service, right? So that was what we were looking for. And then to answer your question, how do we find him? we were looking around and researching people who were focused on S corps. So we were talking to a guy who wrote a book on S corps. And through networking, we found this guy, and he kind of was interested in what we're doing, and he became an advisor. So we said, hey, we run a first season with you in a beta? And that was what got us going. And so we said, okay, well, we know what the customer acquisition cost is. We know that if we ran it as a service, that people will stay. We now know what we should build in theory. Okay, let's raise some money. Let's do it. And then in terms of what we're looking for from a CAC perspective, we looked at a metric of LTV CAC. So basically, as long as we thought it was going to be over 3, that was kind of the metric that we looked at the time.
I love that. I don't know if you have like more time because we already went over a little bit. I want to end with like one real question and like 1 minute fire
Sure,
round, if that's okay. By the
sure.
way, I want to say hi to the audience. Hi, Sandeep. Hi, Pitram. Hi, Thomas. Hi, Bill. Anyway, so love the audience. So I have to give them a shout out. But anyway, so one real question is, in your zone of business, you are, I don't know if you consider yourself like gig economy, creator economy, or fintech or whatever. In your space, what do you think is like the biggest opportunity beside your company?
So it's interesting. We I don't know how you would. So we're fintech because we're, financial services, right? I think often the most popular companies in the past in fintech were credit related, banking related products, but we are a financial services company. We're backed by QED. So I would say fintech is effective. We have also been called vertical SaaS,
Mhm.
right? Because, we're focused on a specific niche, and we provide a subscription product that's driven by software. Um, I don't think creator economy or gig economy would be enough to encapsulate the audience, because business and one again are 38% of people. I think creators are part of the people we can serve. And by the way, we have tons of creators and they helped us out, and we're very grateful to them. We don't actually focus on gig economy that much, because to get an S corp, you have to have a very high income, and most of the people who are in the gig economy today, their income level doesn't rationalize an S corp. However, I'll add one caveat, and then we'll kind of go into this. Is Uber drivers? There's some high end, like a lot of them. There's a lot that need an S corp. So a lot. There was a guy when I was in Uber. Funny story. He was talking about S corp. He was asking me what I did. I kind of said it was more business for finance stuff. Like, you don't talk about startup stuff. And he's like, "Oh, I just did an S corp with this guy down south," and I started giving him advice. And he said he signed up for Collective, or he tried, and he couldn't get into it. And I said, "Oh, well, we're not focused on drivers right now." And he begged me. I mean, it was crazy. He was like near tears for us to help him. And so there's a big opportunity in gig workers, but again, it's a subset of the solopreneurs right now.
Okay, let's go with like the 1 minute fire round. What's your favorite book?
My favorite book. Right now, the book that I read the most often, so I'll call that my favorite just by sheer volume, is The Manual by Epictetus. So it's a Stoic philosophy book written by him, and it's really quite good. You can read it very quickly in one sitting. I've read it. I probably read it 20 times a year.
Who made the biggest impact in your career?
Oh my gosh, I have so many people to thank. So I don't know. Um, Biggest impact in my career. Oh man, so many. I would say probably Phil Bronner, who was one of my early investors, because he was our first check and he really believed in us and brought us up to DC and connect us with the AOL investors and Nigel and everyone else. So he was a pretty big catalyst. Him and another guy, Bobby Asdani, were very early on believing in us when we were frankly very unformed. So I think those were pretty substantial changes in my life after the fact. But like early, Dave Lamont, Frank Demler, woman named Dina Smedes. These are all professors at Carnegie Mellon. So there was like waves. So the Carnegie Mellon people kind of lifted me up and got me into this thing. And then there's people who kind of took me into business, which has been great. But I think having, Tim Ferriss calls it you have the tribe of mentors. If you have this community, you should always, you learn and surround, these people lift you up, even just through ideas, through inspiration. And so you should be connected to these communities, even if it's just as a consumer. It's just so valuable.
Mm. Who will you invite to your dinner party?
Would I invite to my dinner party? Am I allowed to invite anyone I want?
Anyone. It's your party.
Can they be dead or alive?
It's your party.
My party. Well, I mean, since it's my party, I'd love to get like inventors, like the like great inventors, and just like listen to them talk, or like great entrepreneurs. Like, what would it be like to have like Jobs and like Andrew Carnegie, um, alongside like Edison, and see how they really are, like what they would talk about and what they go back and forth on. That would be a cool conversation. I also would like to totally geek out with like hardcore technologists, like Vint Cerfs of the world. So I'd have two parties. I don't think they would sit at the same table, but like, the people that invented the internet, like the guts, like Tim Berners-Lee and Vince Cerf on the TCP/IP, and even Andreessen, Mark Andreessen. I've had the opportunity to hang with him a couple times. I love those conversations. I mean, it's unreal. He made Mosaic. Like he wrote the first browser. Like, how cool is that? Like, you know what I mean? So anything where I can learn from people that really were like the high architects, and getting them in a room would be a pleasure.
Mm. Where can we find you outside of work?
Um, in terms of what I do, or in terms of like socials or whatever.
Everything.
Uh, Activities I like to do. So train studio artist, love to draw, love to play guitar. I've been doing both since I was a very, very little kid, and love to read. I read a book a week. And in terms of where I hang out online, I love X. I almost said Twitter. I'm still retraining my brain to do it. Even though I think it's become a different platform, I still think it's one of my favorites. So all my handles are the same, at Hooman Radfar on most platforms, or at Hooman. So yeah, I love to talk to people there, and I think it's fantastic. I know social media is getting a bad rap, but I think we forget like how much it can bring us together to exchange ideas, to make great things happen. And I'm an optimist, so I still enjoy trying to hang with the people that are optimists there.
On that note, thank you so much, Hooman, for coming on the show today.
Thank you so much for having me. It was fun.